Be Wealthy and Smart, episode 1228.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about what the U.S. credit downgrade means to your finances. Because a couple of days ago, we had the bad news that Fitch had lowered the U.S. credit rating, and it was lowered from AAA to AA+. Fitch said the reason they downgraded U.S. credit was because of the debt load and a weakening of governance. Fitch also expects a recession later this year. This is really all about the ability to repay debt. Higher interest rates means more interest payments. When the Fed raises interest rates, what that does is it adds extra interest onto the debt that we already owe. In fact, most of the U.S. government debt is interest. So it's basically money that we're borrowing and paying interest on, and that keeps accumulating. So it's not even money that's been appropriated or spent, it's just interest. And of course, as we have higher interest, that means the debt grows faster, and now we have it exceeding tax revenue. As you know, a few months ago, we just had a federal stalemate which delayed a debt ceiling agreement until days before the U.S. was expected to lose its ability to pay outstanding financial obligations. So it's not a good situation, we all know that. If investors believe the U.S. can't pay their debt, then interest rates rise and debt becomes more costly. It's sort of a bad spiral that starts to happen. Ultimately, the question is, will the U.S. default on its debt? How is it going to get itself out of this situation? Because it gets to the point where you can't raise taxes high enough to ever pay back the debt. And since most of the debt is interest, couldn't it be something that's easily forgiven? I think it could be. When the deficit continues to spiral out of control, the federal government loses the ability to spend on social welfare programs and projects that stimulate the economy, which will also slow economic growth. But the big problem is the larger the debt, the higher interest rates go, the more federal taxes go to paying interest and not creating anything of value for Americans. Now, even though Fitch has downgraded the credit of the United States one step, Treasury bonds are still seen as the safest asset of any asset, but that perception can change. According to ABC News, if U.S. debt grows and the government struggles to address it, consumers could face higher interest rates for loans, since the nation and its borrowers would be deemed less trustworthy. That would mean higher costs for borrowing for everything from credit cards to mortgages to cars. And it's already difficult for consumers because U.S. borrowing costs are most closely tied to 30-year mortgage rates, and those have already climbed to multi-decade highs this year around 7%. Economists say the credit downgrade represents a warning to taxpayers about the U.S. government's medium and long-term fiscal health. In its downgrade notice, in which Fitch changed the U.S. credit rating, they pointed to repeated fights in the U.S. Congress over raising the debt ceiling. Those conflicts, usually a consequence of Republicans and Democrats' failure to see eye to eye on budgetary and other legislative issues, have increased the risk of a U.S. government default, according to Fitch. Chester Spatt, professor of finance at Carnegie Mellon University and a former economist for the Securities and Exchange Commission, said while the Fitch downgrade has not immediately changed the minds of investors about how much risk they need to consider when lending to the U.S. government, it is a signpost that the U.S. must get its fiscal house in order. Well, I do agree with that, and at some point, U.S. lawmakers will either have to raise taxes or cut spending, and neither one of those are going to be received well. Spatt also said not to say that the U.S. Treasuries are a bad asset or that we won't be able to repay our debt, but I do think the challenges here are a good justification for the downgrade. This is the first downgrade that Fitch has made since 1994, but in 2011, you might remember that the S&P rating agency downgraded the U.S. sovereign rating. At that time, it didn't cause any real forced selling of bonds, and fortunately, the S&P 500 recovered 15% over the following 12 months. Now, while a downgrade to our credit is concerning, and we definitely hope this isn't a trend that continues, it's good to remember that inflation is at its lowest level since the spring of 2021, and economic growth, as measured by gross domestic product, was very robust at 2.4% in the U.S. on an annualized basis in the second quarter. That was while European countries were just getting out of a recession that started in the last quarter of 2022, and relative to other G7 nations, the U.S. economy has maintained the strongest GDP growth by far, and that's enabled us to possibly have a soft landing, meaning the economy may not go into recession even though the Federal Reserve has hiked interest rates 11 times since March 2022 to try to curb inflation. Now, one thing we want to look out for is other credit rating agencies may jump on the bandwagon, and if they do, that's going to be a warning sign. Moody's Investors Service could join Fitch and S&P and downgrade the U.S. one or more notches, and that would make more of a difference than just Fitch doing it. Jose Torres, senior economist at Interactive Brokers, said downgrades across all three major credit rating agencies could impact stocks and rates in markets adversely, as they would raise the cost of capital for corporations and the Treasury alike. The other thing we want to watch for is what are bond yields doing? If bond yields start to go much higher and stay there because investors continue to react negatively to the downgrade, that could have a broader effect, making stocks less attractive than bonds. Torres said asset valuations would come under significant pressure because the fixed income market would serve as an even stronger alternative for investors. Yeah, basically he's saying that if rates rise too much in bonds, then bonds can become more attractive than stocks because bonds can be considered less risky than stocks. So if you can get a higher yield without taking the risk, then investors might jump out of the stock market and into bonds. When we look at the debt, in fiscal year 2022, the U.S. paid $475 billion in interest, or 1.9% of gross domestic product. That amount will nearly triple to $1.4 trillion by 2033, or well over 3% of GDP, according to Congressional Budget Office forecast. And by 2051, spending on interest will be the single largest line item in the federal budget, surpassing Social Security, Medicare, Medicaid, and all other mandatory and discretionary spending programs. So while we're not at a crisis level immediately, it definitely is heading that way. And if interest rates continue to rise, it only gets there sooner. And honestly, none of us are surprised that debt is on an unsustainable course and that the lawmakers have chosen a dysfunctional and unproductive way to address it. But that's exactly what needs to happen. It's up to the lawmakers to get us out of this mess. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my wealth mentoring library on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more personal wealth tips. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.